before you do that. And if you're thinking about buying a house and you're also thinking about being self-employed, buy the house first, then go do whatever it is you want to do.
Thank you for joining my podcast today. On this episode, oh, by the way, as you all know, you are listening to Wealth, Legacy, and Property. On this podcast, we talk about how to generate wealth, leaving a legacy, and leveraging real estate to do that. If this is your first time, welcome. And if you are a repeat listener, welcome to you also. And if you've listened to this podcast, you may have noticed that most of my episodes have been on mortgages. Part of it has to be the fact that within the United States, over 60% of home purchases are done through mortgages, right? So it is very important to talk more about mortgages because from my personal experience, most people don't know much about mortgages. I don't know much and I'm still learning, right? So today I've brought my favorite mortgage expert back on the podcast to tell us more about mortgages, right? On this episode, we are actually going to look at the different types of mortgages, specifically residential mortgages. On previous episode, we did talk about commercial real estate and the type of mortgages that are available. That's why I want to narrow down on residential, since the component is very important too. Welcome back, Ray, to your favorite podcast, and hopefully today you can teach, my listeners and my viewers a little bit more about residential mortgages. You're welcome, Rich.
Super excited to be here. Thank you, Patrick. It's always a pleasure to be on your show. I appreciate the effort that you make to get good information out into people's hands. So I'm super excited about it. I know you want to talk about mortgage types.
Yes.
You want to ask a question? If not, I'll just jump right in.
No, go ahead. So I guess to provide additional context, when it comes to residential mortgages, there are so many types, right? You have FHA, we have conventional, you have even mortgages for investors. Investors, I guess for mortgages that foreign nationals do qualify, which as we speak, you and I are currently working on one deal for a foreign national. So let's start from there. What are the different types of mortgages? And if we can look at the requirements for them also, that would be great. And I guess I can also ask more questions to get some clarification as we go along.
Perfect. So we're going to start with probably the most common mortgage out there, which is known as a conventional mortgage. Conventional mortgages are those that are typically sold by the lenders to Fannie Mae or Freddie Mac. So Fannie Mae or Freddie Mac, what their job is, they are currently, by the way, owned by the government and run by the government. There is some thoughts that maybe they'll be turned back or privatized, which is why Fannie Mae's stock is up 527% since the election. But that's a whole other story. So let's just talk about conventional Fannie Mae and Freddie Mac. Conventional loans are the majority of the loans that are done to purchase and or refinance homes in the United States. These have both Fannie Mae and Freddie Mac are very, very in almost every attribute as far as what they will tolerate for credit, what they will tolerate for income, and how they look at everything. They do have their little differences here and there. A good mortgage professional is going to know what some of those differences. We won't drill into the differences for the most part. If anybody says to you conventional loan, they're talking Fannie Mae or Freddie Mac, and that's those loans. Now, as far as the requirements for those types of loans, currently as it stands, a first-time home buyer would qualify for 3% down, as little as 3% down. If they're not a first-time home buyer, then they're going to be looking at 5% down. So that down payment. One interesting change is that Fannie Mae recently came out and said that they will now allow 5% down for an owner occupant who happens to want to buy a 2, a 3, or a 4 flat. That is a
Yep.
big change for Fannie Mae. Normally, even if the owner occupant was looking at a 2, 3, or 4 flat, you'd be looking at 25% down. So that's
I
a
see.
really nice little nuance there. And they are constantly changing their rules and guidelines. As of January of 25, we'll talk about what the guidelines are today. So
Okay.
again, we've covered the down payment, minimum of 3% for an owner occupant, excuse me. And if we're looking at 2 to 4 unit multifamily, minimum of 5% down.
5%. Okay.
If we're not a first-time home buyer, it's 5% down.
Okay.
So those down payment requirements, as far as credit is concerned, Fannie Mae and Freddie Mac both state that they will go as low as 620. However, once you start dipping below 700, they're definitely looking for more money down. We do occasionally see a 5% down with maybe a 690 credit score, but it's not as common. Once we dip below 700, they're definitely looking for a little bit stronger borrower there.
Okay.
Income to debt ratio wise, both Fannie Mae and Freddie Mac will allow as much as 50% of the gross monthly income to be used towards all the credit debt. So by credit debt, we mean the mortgage payment, car loans, student loans, and credit cards.
Okay.
So that's the income as far as that's concerned. So, and they lend residentially. Fannie Mae and Freddie Mac, it's got to be a residential 1 to 4 unit. The minute you go to 5 units or more, that's commercial.
Right.
Fannie Mae traditionally doesn't lend on that. So that's Fannie Mae and Freddie Mac, and those are your conventional base guidelines.
Okay.
Questions, Patrick? Anything I might need to throw in?
Yes. So you did mention about the debt to income ratio, right? I do understand that a lot of people don't know which of their debt are considered or are thrown into the calculation. That's one. And also, when it comes to income, someone might have a full-time job and a part-time job, right?
Sure.
You know, which one is counted? How about those people that also have a PRN job? Those PRN job, a temporary job that, they it's based on need of the employer, and even how long should they, be at that job for that income actually to be considered as part of the, overall income that will be used for the qualification.
Sure. So the first part of your question talked about debt to income ratios. So we're going to just address that really quickly. So our debt to income ratio is calculated based on the borrower's gross income. So think a W-2 borrower, before all the taxes come out, the insurance come out, whatever, that's that gross number for the month, what we're going to use. Now, for example purposes, I want to give you guys an idea of what the numbers look like. Whenever you Google or do research on debt to income ratios, you're always going to see 2 numbers. The first number that you're going to see, and I'm going to throw out some numbers you would see. If you do research on a conventional loan, you'll see 2 common numbers, 28/36 or 33/38. That's a number that's readily available on the internet. Unfortunately, in the real world, Fannie and Freddie do go much higher than that. But what do the numbers even mean? So let's talk about that real quick. The first number always represents the percentage of gross monthly income going towards the housing debt. Housing debt is considered principal and interest, taxes, insurance, PMI, and any homeowners association. All of that would be considered housing debt. For round numbers in our example today, we're going to take a borrower or a buyer with $4,000 a month in income. And let's say the mortgage payment all in, principal, interest, taxes, insurance, all in is $1,000. $1,000 is actually 25% of $4,000. So our front end ratio would be 25%. Now, what's the second number mean? The second number is the mortgage payment plus any other debt that they have. What kind of debt
Okay.
would that mean? Car loans, student loans, credit card payments, and let's not forget alimony or child support.
Yeah.
Those payments, let's say in our example that we gave you, the borrower is making $4,000 a month, has $1,000 a month mortgage payment, and let's say the car and the credit cards are about $1,000. So their combined debt is $2,000. When you divide it by 4,000, it's 50%. So ultimately, the ratios on that buyer are 25 over 50, Patrick. And it's definitely something that we could do through Fannie Mae or Freddie Mac. So keep in mind, I just told you they would go as high as 50. But if you look it up online, it'll say they don't go higher than 36 or 38. So online information is guidance, but in reality, in the real world, there's definitely some flexibility there. So that covers debt to income. Before I move into income types, any questions about debt to income?
I do have two questions, but I want you to touch on that and we can come back to that right quick, if that's fine with you.
Yeah, okay. So you're going to circle back on that then?
Yes.
Okay, perfect. Okay, so you talked about this second part of your question had to do with if we've got a borrower who has full-time income and part-time income.
Right.
How they're paid is really the most important thing.
Okay.
So the full-time person, if the full-time person is salary or hourly at a guaranteed number of hours a week, pretty simple. We're not, for the most part, we're not even looking for any significant longevity. They could have just landed that job. Maybe they went to school for it. They got the job. They got the salary. They got hourly rate. They're guaranteed 40 hours a week.
Okay.
A part-time job is a completely different animal. Part-time jobs typically require at least a 2-year history of working part-time. Now, ideally 2 years at that same employer. However, we are able to string a couple different part-time jobs together if the client made a change and the industries are similar. So for part-time employment, they look for a 2-year history, not only for a good average, because sometimes part-time hours aren't guaranteed.
Right.
They also want to make sure the person's dedicated to working these extra hours for a length of time, and that the employer is dedicated to actually keeping this type of work. Part-time jobs do tend to come and go. So 2-year history traditionally required on part-time work.
So
go ahead.
Yeah, I'm sorry. Go ahead.
Yeah, the last part of your question, I think, had to do with, are we talking about a self-employed borrower, Patrick?
Yes, a self-employed borrower. And I guess when it comes to the PRN, that could fit under part-time, right? Or am I mistaken?
I'm sorry.
So PRN. So let's take, for instance, especially there are those in the healthcare field, right? Or those that work for agencies. Sometimes, they, to the point that you were making earlier, they might have a full-time gig, right? But they will apply to another agency, and that agency will only call them when they have work for them.
Sure.
Right. So they call it PRN, right? So let's say, for instance, if that full-time employment, the gross income is not enough and they want to add on the PRN gig to it, how will your team look at the PRN?
It's going to be similar as the part-time income. You're going to be looking for a track record of that. It's a common misconception that in the example you gave, hey, my full-time income isn't enough. Let me go get a part-time job so I can go qualify. There's no history of that. So the underwriters, for the most part, are not going to give you credit for that part-time job because we just don't have any track record of it. And the same thing can be considered for that temp placements type of contract work. If there's no consistent history of it, it's just not going to be able to be used.
Okay. So then how about the self-employed individuals?
Yeah, self-employed individuals. So the self-employed has the term self-employment has kind of broadened, certainly over the last 5 years. And so self-employed, we used to think of a small business owner. who ran a storefront, or maybe was manufacturing something, ran a little small auto repair. But self-employment now really amounts to 1099 work. And it could be somebody that's contracting themselves out here, they're getting 1099 income. So a lot of gig workers, think Uber drivers and things like that, they're self-employed.
Or even realtors.
Yeah, certainly realtors, self-employed too. Although you guys have been around a lot more than the 5 years. The Uber driving and all of that, that's definitely a new thing.
Yeah.
So the thing with self-employed, and we'll start with FHA. And FHA, we haven't even talked about that as a program because we were talking about conventional. But FHA as a program, they traditionally require a 2-year history of self-employment. They get a little latitude around 18 months, but traditionally FHA is very hard and fast 2-year history. Fannie Mae will give us a little bit more on a conventional loan. We'll get a little bit more grace if we can establish that the client maybe was doing the same thing under a W-2 heading and just broke off on their own. Ideally, you want to have at least one filed tax return in that setting. Can get away with maybe as little as a year. Definitely going to be an exception basis, and definitely get with your mortgage professional sooner than later before you do that. And if you're thinking about buying a house and you're also thinking about being self-employed, buy the house first, then go do whatever it is you want to do.
Right. So for clarification, when it comes to the self-employment, on its own has a broader umbrella. So the loan type is going to determine, I guess, whether you need 2 years of bank statement. 2 years of tax statement, right?
Yeah.
Or maybe one. To your point, let's say, for instance, the person actually transitioned from a W-2 job to the self-employment job, maybe within that 2-year time frame. At least they should have one tax return for the business, right? Depending on the loan type.
Yeah, I mean, definitely 1 year's tax return. I mean, it's timing is everything, they say, right? So you want to be self-employed longer than you don't. So that first year tax return can be tough, because if you have you started a business with any kind of expenses, all your expenses are lumped into that first year. There's usually a little bit of a lag between starting to get payments. You go incorporate, you get your business license, you get your website, you do the things you need to do, and there's a little lag between that first payment. So that first year tax return usually isn't really strong for qualifying purposes, and it does make it a little bit tougher. Okay.
So from what I'm hearing, even if it's 2 years, right? And they are not getting any revenue, even though they file their taxes, it's more likely not going to be strong enough, because you want to also see some revenue coming in.
Got to see some revenue for sure. Yeah, you got to see some revenue. So yeah, and it just makes it tough for the new self-employed starting out. So it's, people tell me, again, we talked about this. I want to buy a house and I'm thinking about becoming self-employed. If you do the self-employment first, you're 2 years away from buying a house.
Okay.
So think about it that way. Just to be safe, you're about 2 years away from buying the house.
Okay. That makes sense.
There are some exceptions, and we'll talk about that. We probably should circle back to the programs, because we've started talking about conventional and then.
Right. So I do have, I guess, a couple of questions before we go back to the mortgage types, right? Yeah. So you did mention a PMI, right? Can you tell us what a PMI is?
Sure. So PMI does apply to a conventional loan. It is private mortgage insurance. That's exactly what it stands for. What it does is it insures the lender when you come to the table with less than 20% down. So come to the table with less than 20% down, the lender's looking for some sort of guarantee or some sort of additional assurances that if you as a buyer default, they have somebody to go make an insurance claim on. It's truly a claim. Like, look, it's insurance. Buyer defaulted. I lost X amount of dollars. I'm going to go ahead and make an insurance claim. So that's private mortgage insurance. It only applies to conventional lending. Think Fannie Mae and Freddie Mac.
Okay. So it's great you've given us some insight on PMI. From my understanding, let's say if, like as you stated, I'm trying to purchase a new home that I'm going to live in, right? The down payment is that I'm planning on putting down is less than 20%. So there's going to be a PMI. Do I pay the PMI, the initial PMI, the closing day, and also pay every year as long as I still only have, I still have less than 20% equity in the house?
Yeah, so the conventional private mortgage insurance can be paid a couple different ways.
Okay.
The most common way it's paid is monthly. And so if your insurance, it's usually a percentage of the balance is what the PMI is. So you close, your PMI might be $50 a month. So you pay $50 a month, pay $50 a month. Now, getting rid of the PMI is a possibility when you do obtain anywhere from 78 to 80% loan to value. Now, you as a home buyer can obtain that either through doing improvements on your property, so you've actually added value, or paying down the principal so that the principal now gets your loan to an 80% of value. If you don't do, so there's two ways to actually physically do that to get rid of the PMI. One would be just to pay the balance down to 80% of the original purchase price, and then call the lender up and say, hey, by the way, I've paid this down to 80%. I'm requesting that you remove my PMI. That would be one way to do it. The second way to do it is, hey, I paid my balance down a little bit, and I know my equity is going up. So I do feel that now I'm at an 80%. Call the lender up again and say, look, I know I'm at 80% because the homes around here have appreciated 6% a year. I'm 2 years into this deal. I know I'm about 80% based on a little bit of overpayment. What do I need to do? The lender is going to be like, well, you're going to have to get an appraisal. Here's the name and number of an appraiser. Call them, pay them directly. They'll send it in to us. If you're right about the value, we'll release the PMI.
Okay. I guess we can talk more on the PMI on the next episode. I actually had it in mind. I just wanted to flash out the definition so that, the listeners, will understand some of this terminology. So we can dive into that on the next episode. But I guess you can go on and tell us more about the other loan types.
Sure. So one of the next most common loans for first-time buyers is going to be FHA, standing for Federal Housing Authority. Your FHA loan, why it's the next most common is it kind of catches the loans where somebody wouldn't qualify conventional. Why wouldn't they qualify conventional? They qualify for FHA. Well, we'll talk about qualifying for FHA. FHA is a little bit more lax in the credit scoring that it allows. Specifically, they require a 3.5% down minimum. First-time home buyer, doesn't matter to them. It's minimum of 3.5% down. They will lend down to a credit score of 580 with 3.5% down. Now, I have to stop there. That's what FHA does. Some lenders, some banks, some credit unions may say, hey, that's good for FHA, but we as ABC Credit Union, whoever it is, we're going to put an extra rule or overlay, and we're going to say we're not going to lend. We're just, as a company, we're not doing FHA under 620. We just don't feel comfortable with it. That's where our cutoff is. The reason I bring that up, Patrick, is because I've had people come to me and say, well, I want an FHA loan, but the bank turned me down because I had a 619 credit score. 619 credit score will get you an FHA loan. It's just not at the bank because they don't want to lend to that low score. So that's the credit piece. One last thing about credit score and FHA. they will go below a credit score of 580 with 10% down or more. So if you have a bigger equity position, they will consider that with lower credit score. Now, their debt to income ratios are typically higher. Again, if you look this up online, you're going to see numbers of 29 over 41, 31 over 43. Those will be the numbers you'll be able to Google. Ultimately, what we've seen recently is probably something as high as 45 over 55 is something you will get approved through automated underwriting. So FHA used to be a little bit more flexible relative to where the down payment assets were going to come from. Now I think they're probably similar to conventional. They still want to know where money's coming from. They still want to know who's gifting money and where the assets are coming from. We talked about them being a little bit more rigid. They truly need a 2-year track record for self-employed.
Okay. So looking at FHA, one, is it also coming from Freddie Mae and
Fannie Mae or Freddie Mac?
Right.
They do the conventional lending. All the FHA loans and all the government loans are sold to a place called Ginnie Mae.
Okay.
Yeah.
Okay. Going back to their restrictions, right? So as an agent, one of the things that I know when it comes to FHA loans, usually it's tied to inspection, right? So from my understanding, FHA requirements for the condition of the house is usually much stricter compared to conventional. Can you tell us a little bit more about that and why is that the case?
Yeah, so an FHA appraisal is definitely different from a conventional appraisal. They are looking at some aspects of the home relative to safety and that's their big deal. So a conventional appraiser is going to look at things that are obvious. FHA kind of takes it one level higher than that. Couple of things that FHA is going to be looking at. We'll talk about roofs. So FHA definitely wants to make sure the roof has a life of 3 years or more. If the roof's in really bad shape, that roof's going to get flagged on a conventional appraisal anyway. Next biggest thing we see on FHA that you would not see on conventional is peeling paint. Because paint here in the United States prior to 1978 was made with lead, and lead, as it peels, then hits the floor, and babies eat paint chips apparently. So they feel that it's dangerous. If the house was built prior to 1978, if you see peeling paint on the exterior, the interior doesn't matter. They don't care how cold it is. FHA appraiser is going to say, I need this peeling paint scraped and repainted. So that is one of the other common issues that you're going to see on an FHA. Probably the last thing that I see most commonly is missing handrails on stairs or steps coming out of a house. Those are the common things that you're going to see. So is the inspection tougher than a conventional? Yes, but really not by much. The peeling paint's probably the big thing.
Okay. So as an agent, I also know that, let's say, for instance, if I have a listing and the buyer did their due diligence, got an home inspection, they found certain things that needs to be taken care of, like what you've mentioned, right? Looking at conventional, I can tell them that, okay, my client, not me, my clients could tell them that at this time, we don't have the time and energy to make those repairs for you. So we will change the contract from a regular contract to as is, right? The condition as is. And then we will offer you some credit so that you can repair it. From my understanding, does FHA allow as is conditions of a home?
So we talk about this quite a bit with our buyers, that we don't want our buyers, even if they are pre-approved for FHA, not to be scared of a property that's listed as is. As is a traditional statement from the seller that basically just means we're not going to fix anything. Don't ask
Right.
us. Don't bother us with it. You're
Right.
taking the home as is. As is does not mean that you as a buyer don't have the right to a home inspection.
Right.
As is does not mean you have to take it if that home inspection shows that foundation is a major problem.
Mm-hmm.
You can walk away from that property. Seller's already
Okay.
told you they're not going to fix it. Why do you want to inherit a $20,000 foundation repair? A full tear-off roof replacement that could be $18,000. You don't want to inherit those problems. Now, let's say there are a couple things that come up and through the home inspection and or the appraisal inspection, and the seller's already said, hey man, I'm out. Don't bother me with this stuff. It is possible to cure those things with one of two things. Number one, a repair escrow. That means that the buyer on a FHA, let's say you have a couple cracked windows, or an FHA, they are particular about that. If there's a cracked window, baseball hit it, but the baseball didn't go all the way through, they will want that pane reglazed, at least so the crack is not there anymore. So we could have a window contractor come out, give us a bid. Let's say it's $300 for the window. We'll put aside $450, hold it. We, cross country, will hold it, or the lender will hold it. And then when the window's repaired, we'll go ahead and release that money. So you can still buy this home, even though the home's not perfect. Now, let's say it's a bigger repair. Let's say your guy gets in there and they determine that, whoa, we are definitely going to need a foundation on this property. We're going to need to tear out and repair all the drain tiles, and it's a bigger job. You could still close on that property with FHA, but that turns into a renovation loan where we have the repairs to buy that home into the mortgage, and it just becomes part of the mortgage. So there's several ways as a buyer to buy these as-is homes, these homes that need a hug. We can help them and be creative. And you'll notice one thing, Patrick, in none of those examples did we need any help from the seller.
Right. So in essence, what I'm hearing is even with FHA, depending on the condition of the house, you can still purchase the home. But based on the safety condition of the house, you are either going to have to get an escrow set up where the seller is going to provide credit, but you can move it into the house, right?
Yeah, but you don't need, I want to cut you off there. So because I don't need a credit from the seller. So we talked about it. The seller says, hey man, don't bother me. I'm not fixing anything. So let's go back to that window replacement. All we would need is the buyer to set aside an additional $450 and throw it in there. Now, you as an agent, like if it doesn't say as is, absolutely go back and ask the seller for the repair credit and deal with it later. But if they said as is, it's unlikely they're going to give you that repair credit.
Right. So, and I guess I want to flash something out, from my experience dealing with even my own purchases or my own transactions, right? And with my clients, even though they say it's as is, that does not mean that we cannot go back and renegotiate, the purchase price, and also by asking for a credit, to work on stuff like this. So I'll give you, a very good example. The current deal that we are working on, right, after inspection, we found a few things, and it's like, okay, we agreed to a $360,000, purchase price, but all these repairs are going to cost us about $5,000. So we need, you need to meet us somewhere. They came back and offered $3,500, right? Credit for my client to go ahead and use that for the repair. So in my mind, I guess the reason why I stated that the credit is going to come from the seller is because as an agent, I don't want my client to bear all that burden, right? Sure. So, but I guess to your point, you don't care where the money is coming from, as long as an escrow is going to be set up to have the funds to do that repair, that loan can go through. And as a matter of fact, your team, let me take this back because it wasn't actually your team, because my client was the seller. So the buyer's mortgage company actually did something similar last year for one of my deals because they wanted a repair and my client wasn't ready to make the repair. So we offered them the credit and they ended up putting it into an escrow. So I guess it makes sense to me now.
Yeah, perfect. So,
Okay.
so that's, I mean, that's the FHA side of it, and I know we kind of addressed the appraisal side of it. Not anything to
Mm-hmm.
be super concerned about it. If we're going to go into the next loan type, I want to talk about VA or the Veterans Administration.
Yep.
So this is a specific loan for eligible veterans, where
Okay.
they can come in and put as little as 0% down. Now,
Okay.
I say eligible veterans because there is a certain amount of what they call points that you have to gather to actually have what's called a certificate of eligibility that
Okay.
allows a veteran to go ahead and buy a home with no money down. So, so we always, one of the first things that we do when a client calls us is we now, thankfully, the VA is kind of caught up to technology. We can go online and pull their certificate and make
Okay.
sure they have eligibility for it. It's a great program. We don't have a lot of military bases here other than the Great Lakes. So we don't see as many VA loans here in the Chicago market as you would in other markets like San Diego, where there's big
Mm-hmm.
bases, and Virginia and places like that. But it's still a great loan. The as far as the credit is concerned, you're probably still looking somewhere between 640 ish on the VA
Okay.
side. A lot of their guidelines mirror FHA.
Okay.
So you'll see a lot of similarities there as far as that's concerned. The biggest thing really for the veteran, no money down, gotta be eligible. And those are probably the big things that stand out on the VA loan. The VA loans
Okay.
are then sold to Jenny Mae as well.
Okay.
Any questions about those, Patrick?
Yeah, it's, I guess it's going to be clarification. So looking at someone putting, let's say, 3% down compared to someone putting 0% down, right? At the end of the day, it's still going to affect the mortgage payment because the interest rate is going to be based on the principal, right? So with a VA loan, let's say I have a client who is a veteran, right? Or still an active duty
Active
soldier,
military personnel.
military, right? So they are considering either going with VA or let's say FHA, right? What is going to be the driving factor, or what is going to affect their decision?
Yeah, I'm going to take the VA all day if I have a choice because
Okay.
there is no monthly mortgage insurance.
Okay.
So
Okay.
there is no monthly mortgage insurance. So we didn't cover this on the VA side or on the FHA side. FHA is not, their mortgage insurance is referred to as just that, mortgage insurance. It's not
Okay.
PMI because P stands for private. This is not,
Okay.
once you get into the government loans, it's not private anymore. It's just mortgage insurance
Okay.
that goes to HUD as far as the FHA loans are concerned.
Mm-hmm.
Your VA loan does not have a monthly mortgage insurance. So I'm taking the VA loan all day.
I see. That makes sense. So I guess the question that I did ask earlier on about the PMI, I may be confusing conventional with FHA because with FHA, from what I'm hearing, not only are you going to pay monthly for the private insurance, but on the day that you are closing, you still have to pay something, right?
Yeah. So, and it's not private insurance. So again, FHA
Right.
is just mortgage insurance, not P. Just
Okay.
mortgage insurance,
Right.
just MI. Just think of it as MI.
Okay.
So with the MI, yes, you will pay monthly with FHA, but they also charge something called upfront mortgage insurance premium, currently
Right.
1.75% of the loan. So for every $100,000 financed, an extra $1,750 gets tossed up onto the top and does get financed. So, I mean, that's certainly a lot of money to think about.
Yeah.
As far as that's concerned, you're talking on a $200,000 loan. $3,500. That money there goes directly to HUD, and it basically takes care of a bank if they lose money on an FHA loan somewhere else around the country. They're going to tap into that fund. So yeah, that's so with FHA, it's kind of a double whammy. It's, hey, I'm going to get you up front and I'm going to get you monthly.
Right.
So yeah.
So in essence, looking at conventional, right, with either 3%, let's stick to the 5%, because in my mind, if I'm going to pay about 1 point something percentage upfront, which is not going to be an equity for me, if I added to that 3.5, that's almost 5% anyways that I could have gained equity in my property, right? So trying to understand this, the only way someone is probably going to be driven to go with FHA has to do with the requirement. One, the credit score. Two, the debt to income ratio, right? Mm-hmm. So, okay, I guess that makes sense to me now, because it's not necessarily wanting to get that 3.5 to go FHA, because you could also even get 3.3% as conventional.
Correct.
Is that what I'm hearing? Okay.
Yeah, I mean, we're going to go down the line. Obviously, we're going to find out if our client's a veteran, because we would like to give them that opportunity to take the VA loan first. And just because the VA loan's zero down doesn't mean you can't put money down. We have veterans all the time that'll come in with 5 or 10% down. Okay. Or, I mean, sometimes veterans are just more comfortable with a VA loan. They just want to keep that going. Okay. Right. So VA first, certainly. Conventional next, and then certainly FHA. And FHA is a great program. It just happens to cast a wider net as far as people that it will help to get in. Our third loan program type is what we'll call non-QM. Non-QM is what we call non-qualified mortgage. A non-qualified mortgage or a portfolio loan is basically the lender saying, hey, I'm going to make a loan, but I'm going to do it on my own set of terms. So, and banks have portfolio loans. The bank says, hey, I'm willing to lend my money out, but I'm going to make my own guidelines up. Don't ask me a bank's guidelines. I have no idea. So we'll talk about the things, a mortgage company. We are what's called an independent mortgage banker. We'll talk about what we have available as a non-QM loan or non-agency loan. Non-agency is a great description for it, because it's loans that don't qualify for Fannie, Freddie, or Ginnie. So no conventional, no FHA, VA. So on the non-qualified loans, then we talk about your client who's a foreign national. We talk about making bank statement loans available. We talk about I-10 loans. It covers a wide variety of different types of product offerings for investors. We talk about cash flow loans. This loan type is very, very broad and honestly could serve its own podcast in its entirety. We're just going to cover it briefly to say that when you start talking about non-agency lending, yes, there is some of that out there. It's become much more common since back in about 2008, 2016, 2018, we started seeing more and more product. We here across country do actually make those loans and sell them direct to Wall Street. So Wall Street will take that risk. These aren't the same types of loans that got everybody in trouble in the beginning of the century. These loans do have bigger requirements. They typically are looking for credit scores, higher credit scores, and they are definitely looking for down payment. What got us in trouble between 2005 and 2008 during the housing bubble were loans were 80-20 loans. Hey, you don't have to put anything down. It's cool. Come on in. We'll get you the house. These loans today require equity, so down payment, and they definitely require a credit score. They have to make sense. And honestly, those loans right now, Patrick, are performing very, very well. So there's just more money available for them.
Thank you so much, Rich. I know, we are short on time. as you stated, hopefully we'll get an opportunity for you to come in to tell us more about those type of loans. I wanted to focus more on the residential loans, since that is very important. When it comes to investors and stuff like that, their thinking is slightly different. We can set up another time just to talk more about them. On our next episode, we are also going to look at a few things pertaining to loans and loan payment. So thank you so much, Rich, for blessing us with your presence today.
Thanks. I'm blessed to be here to help out, provide information. If you need more information about mortgages, 847-603-2300. Thank you very much for Patrick. If you need a great realtor, definitely look up Patrick as well.
Thank you, Rich. Okay.